the cyclical trade, the inflation trade. Is this still on?
Well, good morning, and thanks for having me on your show. And I do think it's still on, but we have shifted down gears. So let me just kind of unpack this and go through this here a little bit. What we have to understand is that the delta, or the rate of change, is really what matters the most to bond investors. So in the first quarter, and even in parts of the second quarter, what we were seeing is rising growth, rising inflation, and an increase in policy easiness. Policy was getting easier. At this point, what the market is sensing is that we're past the peak. Growth is going to decelerate. Inflation is likely to decelerate. And policy, we're past the peak in policy, and we're already starting to talk about ways to take that away. Now, that doesn't mean that the level of growth is bad. That doesn't mean that the level of inflation is too low, or that the level of policy easiness is that policy is too tight. But what it does mean is that we're past the peak. So essentially, the reflation trade that we're talking about is still going to be there. It's just going to take a bit longer to actually achieve these goals. So for example, if we start to think about the more macro elements that make up the reflation trade, right, there are three of those. One is that you got higher 10-year yields. Then you got higher 10-year yields, or higher long-term yields, and a steepening of the curve, which is pretty rare in and of itself. And you also got a weaker dollar. So what happened is, when everybody got into the reflation trades, they were underweight treasuries, they had curve steepeners on, and they were short the dollar.
Right.
And now that the rate of change, or the pace of that move, is starting to decline, the second derivative, as they say, people are unwinding their short in the dollar, they're taking off their curve steepeners, and they're buying back their underweight in U.S. treasuries, and that's what's making this all happen.